Chris, can I start with you? This budget is clearly key in terms of where Australia goes into the future for future generations. There's significantly more money coming in the door than what was anticipated. There are more taxpayers in work. There's also greater company taxes. Really, the government and the Reserve Bank between them have got the throttle wide open on the Australian economy. How long can they actually do this for, do you think?
Well, they can keep doing it for a while, partly because there is still some potential for the Australian economy to catch up to where it was. There are still some unemployed people who don't have to be unemployed. There are shops and offices that could be more full than they are. There are certainly planes that don't need to be on the ground that could be out there in the air. Or in other words, there's capacity in the economy. Even better, still the government has updated its target. You know, if its basic game plan is to repair the economy and use that to repair the budget, it's saying that to repair the economy, it can run harder than it previously thought. It can drive unemployment under 5%.
But that being the case, Bill, we're already hearing from many employers about rising wage costs, labour shortages. Is it a case whereby the government can do all of this and still not have inflation take off and therefore need in the long term to have interest rates rise, potentially causing, as Shane Elliott, the boss of the ANZ Bank, told me this week, potentially some sort of a fiscal cliff down the track?
Look, Ross, I don't think we've seen any real evidence of upward pressure on wages at this stage. We've certainly seen some much faster improvement in the labour market than we expected, but I wouldn't expect to see genuine upward pressure on wages until we get to what I would consider as full employment. And I think that's in the high threes, so I think it's actually below 4%. So whereas the government is talking about fiscal repair once the unemployment rate gets to 4.5%, I don't think that's ambitious enough, and I would expect that we should allow the economy to get down to that high threes unemployment rate near 4% before we start to put on the brakes. And I think that's the attitude the Reserve Bank's going to take. And I expect them to be extraordinarily patient in this cycle and the government to take a fairly similar approach.
So does that mean, Bill, that, say, for example, we know that government debt is rising, and even though they're lower than anticipated, that budget deficits are going to continue to mount? If they are more patient, clearly that means there is also significant amounts of debt, government debt, that's going to be in the economy. They're literally taking no chances that they actually fall back into recession, at least in the short term anyway.
Well, Ross, we're seeing the deficits fall. Our forecasts for this budget are that the deficit in 2021 will be around 155 billion, and by the time we get to 24-25, it'll be in the 30s. So we're definitely seeing a substantial fall in the level of the deficit, and the debt as a proportion of GDP looks to be stabilising in that mid-30% range. So I don't really see it as being what I would call any sort of a concern about providing support for the economy, stabilising the debt as a proportion of GDP, and actually getting the deficit down substantially.
Well, Ross, just a quick thought. So I couldn't agree more with what Bill just said. You know, basically, sure, debt has jumped, but interest rates have gone down a long way, and they'll stay down for a while. And so the Treasurer's already said, reveal one thing that he'll lay out on budget night, that the cost to the government of interest payments on its debt will be lower in each and every year over the next 4 years than it was in 2018-19. And I don't think people realise that. The key is not the debt, the key is the cost of the debt. And that's not scary. And the other thing that Bill has said, and I would entirely agree, I'm not currently scared by inflation. We haven't driven unemployment, and for that matter, underemployment, low enough to goose wages for a while now. Now, that may be an unemployment rate of 4.5%, or it may, as Bill says, be even lower than that. But there's a way to go, I think, before we need to be scared of sustainable inflation.
Okay, so the other question about this is whether we're getting bang for our buck in terms of the debt that's being accumulated and also the deficits that will go on while this stimulus is occurring. I mean, is it really leaving a lasting legacy for Australia, or is it simply placing bandages over the economy in the hope that long term you get the growth and you do get that fiscal recovery?
I'd certainly say reform's been missing, and to be fair, it's been hard for a long time, and it's been hard through this crisis as well. So you wouldn't say that the government is necessarily getting maximum bang for the buck, but to have avoided a much bigger recession is itself a pretty big benefit for the future, and the cost of that was markedly low, not merely those interest costs that I mentioned, but to Bill's point around government debt, Australia entered this with low government debt in world terms. And the increase in our government debt will be relatively low compared to a bunch of others as well.
So, Bill, when I come to this, I go to the bang for our buck. Is it really something that we need to even be concerned about right now, or is it the risk of a secondary recession is greater than what might take place, the debts that are being accumulated?
Look, Ross, there are some forms of spending that are more productive than others. I would give a big tick to the money that the government's going to put into childcare, $1.7 billion a year. In fact, I would have expected quite a deal more than that. Many of the industry groups are talking about $5 billion a year. So I think to boost our participation in the economy, more money on childcare was something I would have supported. The other one that I'm uncomfortable with is the extension of the lower middle income tax offset for another year, which seems to be the case. That was introduced as a stopgap before the stage 2 tax cuts would have been introduced. It's going to cost about $7 billion a year. It'll cost about $17 or $18 billion a year for the stage 3 tax cuts. I would have preferred to have seen them brought forward to 2022 at a net cost of about $10 billion. But those ones, I think, will really add to productivity. It'll add to participation. Australians are aspirational. I think 2 years delay in introducing that stage 3 tax cut, we can afford to do it. I would have thought that over the 2 years, given that next year is going to be an election budget, and we may well see another extension of that LMTO. So over the 2 years, a cost of about a net $20 billion, when you think that the deficit, I think, over the course of the 5 years will be about $170 billion improvement relative to MyEFO. I think that's the sort of policy that the government should have considered, and I suspect that they're not going to consider on budget night.
It's going to be fascinating to watch that. And Chris, the other thing also quite clearly is iron ore prices. The government in the last budget had just a $55 US a tonne price for the iron ore. It's now closer to $195 US a tonne, give or take. The fact is there's a lot more money now. They're always very conservative about this money. But the question is, how real is it in terms of propping up this budget and this spending right now?
Oh, look, the iron ore stuff really, really helps short term. It's not the only thing, of course, so because Australia's kept COVID numbers low, our families are out and about and they're spending. That's helped get confidence back. That's helped get jobs back. So it's not just iron ore prices, but it is a good backdrop whether you're looking at jobs, whether you're looking at iron ore and other commodity prices, whether you're looking at the amount of spending in the economy. That's a very good backdrop for the budget.
And so it seems to me, Chris, that at least, and also to Bill, but I'll start with Chris, and that is you seem pretty relaxed about it. It looks as though there's not too many, sort of storm clouds on the horizon for our economy. Can you see anything that really does give you some cause for this quiet at the moment?
We're not out of the COVID crisis. We're relatively slow around vaccinations here, and many people will have to wait for Pfizer. But it's a similar story around the world. It's going slowly. And that great global tug of war, vaccinations versus mutations, what you're seeing in India right now, is a reminder that this remains dangerous. So there are certainly still risks out there, but it is another reason not to pull back too far or too fast on the budget. I think broadly what's happening on that front is sensible.
And Bill, what about you? Are there any storm clouds out there for you?
Ross, I completely agree with Chris's points about the uncertainty around the health situation. But when we look at previous cycles, we usually look at a policy mistake that generates issues. And I think this time central banks around the world are taking a different attitude. In the past, they felt they needed to be preemptive. They needed to worry about inflation signals before inflation was actually delivered, worrying that it would overshoot. I think this time they're going to wait to actually see the inflation. So an early tightening in interest rates across the world, which is usually a significant problem for the world economy. I don't see that happening this time. So I'm not worried about a major policy mistake. And of course, as we've already discussed, fiscal policy is going to remain expansionary around the world as well. So apart from the uncertainty around the health situation, the big issues around policy mistakes, I think we're facing some of the best environment that we've seen for some time.
Bill Evans, Chief Economist at Westpac, and also Chris Richardson from Deloitte Access Economics. I appreciate your time today.